Welcome to TMS Insights. It's the end of October and it's Jeremy Hook and Ben Clark bringing you the updated news from the market activity. And Ben, it's been an outstanding month. The market's been up 4% in October alone.
Yeah, October does it again. This is historically one of the strongest performing months of the year, and we're coming into one of the strongest performing quarters of the year as well, into the December quarter. So it feels like our market's building some momentum. We touched 6,000 on the All Ords a couple of days ago. And if we just had a bit more participation from the blue chip shares in our market as well, which really have just been treading water for most of the year, we will hopefully see a move through there into the end of 2017.
And sort of summarising it up in terms of the assets, I mean, property has definitely started to slow down. Interest rates, we know, very much on hold with CPI data out during the month showing that there is no inflation. So shares could get actually quite an expansion in PE and price on the back of there being no better alternative, and shares being quite a good one.
Yeah, I think we're in a really good spot at the moment. The only thing that surprises me is how much scepticism there is out there about what the share market's going to do. But, for the first time since the GFC, we have all major geopolitical regions growing, quite in some cases quite strongly. In Australia, we're seeing, I think, quite strong levels of economic growth, good employment markets, but there's enough there that the RBA is not going to push up interest rates.
Yeah.
So that's really advantageous to a share market moving higher.
You use that term scepticism, but we know we're well behind the US in terms of performance, and their FANG stocks, the big tech stocks, have been fantastic. They still describe it as one of the most unloved rallies of all time in the market over there. So it's a bit common here.
It is, and I think it's, we haven't had a correction in the US market for what feels like a very long time, and actually you could say that about our market as well. So maybe we will get a correction leading into Christmas and then a rally going through to December, because I think we are overdue for it. But again, the US has just hit their quarterly earnings season, and some of these results coming out of the US technology shares are unbelievable. I mean, we saw Amazon rise 13% on the back of its numbers, and that's one of the largest companies in America.
These are massive companies rising by big amounts.
Big amounts. So Atlassian, the Australian company, rose 25% on its result. So the thing that is a bit different this time is that share prices aren't just moving higher because there's an improvement in sentiment. It's because the earnings are growing and growing faster than investors expected. So there's real fundamentals.
That's sustainable. That's the thing. Earnings, very good. Now let's talk about some earnings numbers. We've had bank reporting season commence, and it goes through into November as well. Been not a lot expected, but numbers reasonable, certainly from ANZ.
Yeah, I thought the numbers were pretty good. You're right, there's not a lot of earnings growth in the banks at the moment, but I think the numbers are coming in a bit better than the market anticipated. Of course, we've got through the APRA unquestionably strong verdict after many years of waiting. And I guess probably the biggest threat out there to the banks at the moment is a Royal Commission.
Which grew in likelihood with the Barnaby Joyce ruling in the High Court last Friday.
Yep.
So that's something to watch.
Yep.
But ANZ dividend maintained, payout ratio falling.
Yep.
Return on equity was a bit better than last time.
Yep.
So overall,
reasons to
healthy.
be there.
Yeah. And coming up for the other banks, we should largely expect the same.
I think so. I think NAB is still the sort of the bolter of the banks.
Yeah.
And the one I still think looks appealing now that CBA has had a good bounce, and that looked quite cheap for a shortish period of time there after their scandal, and has recovered somewhat since then. So, I think the banks are paying great dividends. There's a bit of earnings growth. It's things that the clients look for.
We had Wesfarmers give sales numbers for Coles in the supermarkets last week. We had Woolworths this week. Now, Woolworths has clearly got the edge on Coles at the moment.
Definitely. I mean, so Coles had sales growth of minus 0.8%. Not a great set of numbers, really. No. And Woolworths today have come out with 4.9% sales growth, which is one of the strongest sort of quarters that we've seen from them. So, they're both great companies, right? And Wesfarmers have got other good businesses
Yeah.
aside from Coles and pay a much better dividend, which some people are there for. But if I was having a bet, I reckon Woolies will be the one that outperforms the next 12 to 24
got
months.
momentum, and
It
that's
does, yeah.
very important in that game. So we like that. Now, just generally speaking, there's been a bit of news. We're in AGM season now, so companies are giving us some news updates. There have been a number of very good ones and a couple not so good lately, Ben. We want to maybe just cover off a few and then look at some share price action too.
Yeah, well, I guess, there's been a series of, a lot of money's gone back into the growth stocks again and been backed up by some pretty bullish statements. But then there's, things like Invicare's hit an all-time high in the last week. Blackmores has had a phenomenal run in the last couple of months. Seek and REA and ResMed, which are sort of big holdings for our company, have all-time highs. Yeah. So that area is doing really well. Isentia was one we had an update from, which was a shocker, I thought. And clearly the business has not delivered the recovery this year that the CEO predicted it would. But aside from that, it feels a lot more positive.
Yeah.
And I think a couple of the other stocks that were problematic are showing clear signs of turning around. And still look sort of unloved valuation-wise, so they could actually do quite well as well, particularly those telcos, I think, would be an area.
Yes, I agree with that. Yeah, it's a bit of positive news building maybe eventually on the NBN in time. Yeah. So, and just maybe coming across then a thought, Fairfax. We've had a little bit of a look at Fairfax at the moment because after a long time of working out what they wanted to do, they have announced that they will be proposing to split their domain business into a separate arm. Ben, they'll be giving 40% to shareholders in Fairfax. If you hold 10 shares in Fairfax, you'll get 1 share in domain. And Fairfax will retain 60% of the business. So the meeting's on Thursday, the 2nd of November. The stock domain should list on the 16th of November. This is an interesting space at the moment, Ben.
It is. REA would be a core holding for most clients' accounts, and it's hit an all-time high today, and that's on the back of a slowing housing market on the east coast of the country. There's more stock coming onto the market. Things are taking longer to sell. You're needing to advertise harder to get interest. Finally, that swung back into favour for realestate.com, but the same will be true for Domain. So, if you look at Fairfax, there's a series of print assets in there and radio. Long-term structural decline, it's just a cost-out sort of exercise. And then you've got a brilliant growing business within there, which despite being managed by Fairfax has still done well. And, I think the idea, post a couple of takeover bids, spin it off, show the market what it's worth, and let it run off on its own path. And, we've seen a lot of companies that have been spun out of larger parents have gone on to be great investments, and we could list a whole number of them. And we know that the structural sort of backdrop at the moment is really positive for Domain. I actually also think Fairfax could do quite well post spin-off, in that the government got rid of the cross-media ownership laws, and that will see a wave of friendly mergers, I think, in the space. It'll take some costs out of their business for a few years, probably see some better earnings growth. And so, both parts of it, one might be a year or two hold, and one might be a longer-term hold, as REA has been. And, hopefully the two in time will be a much better combined value than the current price of Fairfax.
Because Fairfax will definitely get a reflected appreciation of its 60% stake.
Exactly.
In Domain,
yeah. So it'll give us a valuation. And that's how REA at the moment, News Corp owns 62% of REA, and this is almost identical how they're doing it.
And guarantees a tight register ultimately as well. So
yep.
Give us a call if you'd like to talk to us about Fairfax and Domain, or anything else, of course. But that's all we've got time for on this Insights. We look forward to updating you again in November.